Welcome to the Corporate Treasury 101 podcast. Today, we continue our series of episodes on working capital management. In the previous episode, we covered what a balance sheet is along with assets and liabilities. Today, we get a little bit closer to working capital management and therefore we break down current assets and current liabilities. Therefore, in this episode, expect to learn what are current assets and the different categories such as market securities or prepaid liabilities or expenses, for instance. What is the cash conversion cycle? What are current liabilities and some examples of it? And much more. This is the second snippet of our episode on working capital management. Next week, we will tackle how companies can actually manage and optimize their working capital. If you enjoyed the episode, please do not hesitate to rate us on your favorite podcast app. This is the best way to show us your support and to help the podcast grow. We are also on Instagram, and this is the best way to contact us if you would like to reach out or ask specific questions on corporate treasury, for instance. If you're interested, head to @Corporate Treasury 101 on Instagram. With all that being said, let's get on with the show.
So we've talked about assets and liabilities. What do you mean by current assets and current liabilities? Because that's what you said was actually about working capital.
Yeah, indeed. So those are the short-term ones we want to focus on. We quickly described it when we went through all the different types of assets, the different types of liability. But let's dive into it. So you know, Hussam, that we like to give the full picture before diving into it. And we already quickly touched upon what current assets and liability stands for. As part of the larger category they fall in, assets and liability.
Okay, but what's a current asset, for instance, compared to the fixed and tangible financial ones?
So the very simple definition is all the assets that can be turned into cash within a year. And you may draw the link here with some short-term debt and funding that we talked about in previous episodes. But it's really everything that can be turned into cash within a year, so less than 12 months.
I hope most assets can be converted into cash within a year, right? If you could sell it.
Why so? Like, don't you think there are some things that can take like much more time to sell? I don't know. If you have like Hussam's Cafe, you have like 50 buildings in Belgium only at the end of your life because you've been super successful. Do you think you can, for instance, sell 50 buildings in 1 year?
No, but you could sell any number of them, right? You could sell maybe 10, and it could be any of the 50, 10 of any of the 50, right?
So you could try, but then you would want, I guess, to sell them at a good price. And so that will take some negotiations. You need to find a buyer, and then this buyer needs to find the funds. And all this can take quite some time. So typically building, for instance, they are not considered as short-term or like current assets because it takes so much time to sell them. And also if you are decreasing them, depreciating them, that would fall under more long-term assets. So it depends, I'd say.
Okay, so what are examples of the current assets then?
So cash to begin with, right? It's already turned into cash. So that is very current assets that can be used overnight, basically, if not faster. Very short-term investments as well, such as certificates of deposit. We saw this instrument when we talked about short-term investments. Money market funds as well, short-term government bonds, and treasury bills. Those are really financial assets, but we can see them as current ones for sure.
Okay, and I'm guessing you can, corporate treasurers love to categorize things, 100%. I've learned. So I'm guessing you can categorize these into different types of current assets.
Yes, we have categories into the categories. So we talk about here cash or cash equivalents, right? What I just gave as examples fall into those categories. Then we have marketable securities types of current assets. Account receivables are also current assets, given they're going to be paid within 30, 60, or 90 days, right? Your client usually pay you short term. Inventory, typically, or if we are not looking at some very long-term sales cycles industries, inventory will most likely be a current asset. Prepaid liability and expenses as well, and other short-term investment. Those are the 6 categories we find out there.
I've heard of most of them, Guillaume, but what's marketable
I had to make a little bit of
securities?
research as well when I found this term. So those are the liquid investments that can be quickly converted into cash without reducing their market value. What does it mean? So for instance, shares of a company, right? Stock that has a large amount of shares on the markets and of which a company owes a piece. If you sell them, given there is like a very large amount of it on the markets, you most likely won't affect their value in a negative or positive way. This is marketable securities. Does it make sense?
They don't change the value in the market, so they don't follow the typical supply-demand curves. Is that kind of
So yeah,
how you should think about it?
could be seen like this. If we take an example, for instance, let's say, let's talk about Tesla. Let's say I, Guillaume, I'm a small investor, and at some point, I need some cash in the short term to buy my house, for instance, and I decide to sell my shares, stocks of Tesla. As successful as I might be, it's very likely that the amount of shares I own won't affect the market too drastically if I sell them. Elon Musk, on the other hand, if he decides all of a sudden to sell all his shares of Tesla, I don't know how much he owns in total, but probably quite a bunch. This will affect the whole market, right? Because we will somebody who owns, I don't know, I'm saying something, 10% of the company is selling everything right now. Something's off. The shares of the company will probably go down. So marketable securities will be all types of short-term investment that could be sold without decreasing the value of this very thing that is sold.
Okay. So you also mentioned prepaid liabilities and expenses. What's that mean? Prepaid liabilities and expenses?
So those corresponds to payment you have already made as a company for goods and services you haven't received yet. So it's a bit the opposite of accounts payables, something you received the goods or the service for but haven't paid for yet. Something you paid for in advance, somebody owes it to you or to your company, most likely. So although can hardly be turned into cash, those are payments you don't need to do anymore. So it's in a way a current asset. And it can be seen as an economic resource that another company or individual owe your company.
It says when you make advance payments on things, so you're owed a good which you've already paid for.
Yeah.
So that shows up as you've paid for it, but you don't have the asset, let's say.
Exactly.
So that in itself is an asset, like the fact that you're going to receive the thing. Okay, very clear. And then current liabilities then.
Yeah.
That would be similar, I guess, something to do with 12 months again?
Absolutely. And it will be rather straightforward, given it's the same thing as current assets, actually. But on the other side of the balance sheet, again. So current liabilities are financial obligations that are due within 12 months, you're spot on, or within a normal operating cycle.
What's a normal operating cycle? What does that mean?
I knew you were going to come up with that question, Sam. So it corresponds to the time it takes a company to purchase products or raw materials, depending on the industry, or inventory, and convert it into cash from sales. This is also referred to as the cash conversion cycle. And this one is an interesting one. It's a term that is going to come back a lot in working capital management and corporate treasury. So it will be quite handy for the later in the podcast.
Okay, so current liabilities, you'd have like examples of that, like what would be examples of current liabilities?
So you gave one earlier, which are the account payables. We already talked about it multiple times in this podcast. It's basically one of the major current assets, current liabilities. So it corresponds to the supplier's invoice that still needs to be paid thanks to payment delays. And in an ideal scenario, you want to receive money from your customers even before you have to pay your suppliers.
So, okay, so it's account payables being invoices that you still need to pay, of course, within your 12 months.
Yeah, spot on.
Right?
Yeah.
Okay. What else? I mean, that seems like just that doesn't make sense. What else would you need to pay within things like, I don't know, wages would come under this, no? Current liabilities?
Indeed, yeah, absolutely. Wages is part of it, and it's easy because it comes back every month. So this one is quite predictable, but it is a current liability. We can also think about the dividends to be paid to the shareholders, for instance, or to any other debt holder. Or debt holder will more be interests, which is the second one, interest to be paid. Also, those from long-term obligations if they need to be paid within the year. So under current liabilities, you will have the interest you need to pay from short-term debt, so typically 30 or 60 days kind of debt, but also the long-term ones that comes due within your year, within the year you're looking at. Taxes related to income is another type of current liability, prepayments that you received from customers. So this one is the other way around than the current assets. So it's payments you received for work you have not yet completed. And another that can be important is the long-term debt that matures within the coming year. So not only the interest to be paid, but also the long-term debt that you need to repay within the next month or within the year.
So basically, a current liability is you being on the other end of someone else's current asset, right?
That's a very interesting way to put it. Yeah, indeed. That's it.
So a current asset to someone is a current liability to someone else, I guess.
Oh,
Right?
that's
So,
beautiful. Yeah, indeed.
yeah.
So as an individual, we often repay debt over time, for instance, just to come back on the long-term one that matures within the year. And typically, the loan for your house is repaid every month, right, during many years. For businesses, it is common to repay the capital of a loan all at once, so at the end of it, when it matures. And repaying capital is different from the interest of the loan. So you both need to repay interest on short-term and long-term debt if it's due within your year, but also long-term debt that matures within the year you're looking at. So this is the small subtlety regarding current liabilities that we didn't touch upon in current assets.
Yeah. And of course, you want all that to be positive, right? Your shareholder equity should be a positive ratio between your current assets and your current liabilities. Because
Absolutely.
then if you had to repay all your debts tomorrow, you also know you're owed all your debts as well within the same short period of time.
Yeah.
But your cash flow could still be negative, right? Because you could be paid your short-term assets, so your current assets, after your current liabilities are due. So you'd still have a cash flow issue.
So then you indeed
Potentially.
still need to
12
look
months
at your year.
12
Absolutely.
months is a big blind time period, right?
Yeah, 100%. And this is spot on. And this is precisely what working capital management is. And I propose that we dive into this in the third section of this episode.